Well, hello, ladies and gentlemen. Welcome to the latest installment of the Trader's Edge. Today, we're going to be talking about the gold-silver ratio, or otherwise known as the gold-silver spread. We're going to revisit this ratio. We've talked about it a couple of times in the last year, and it's had some major moves, so it's definitely worthy of discussion. Quick disclaimer here, neither futures trading nor swaps trading are suitable for all investors. Each involves the risk of loss. So, do your homework. All right, so one strategy that's captured the attention of traders, especially spread traders, has been this gold-silver ratio, or the gold-silver spread. All right, it's merely the number of ounces of silver required to buy 1 ounce of gold. All you got to do is divide the price of gold by the price of silver, and you get the ratio. During the unfolding of the pandemic in March and April of 2020, the ratio hit 125, making silver futures cheaper than they've ever been relative to gold futures. By the way, you can do the ratio using the spot prices too if you have that data, and it was about 112. So it's a little bit of a difference or a basis between the ratio in futures and spot, which makes sense. With gold currently trading at around $17.33 and silver trading a little bit above $26 an ounce, the ratio is right around 66. So we have a couple charts. One's long-term. It's the spot market ratio. I'm giving you both because you might see both out there in the marketplace. Gold and silver ratio since 1990. And you can see it's topped out at 112. It went as low as 38 or 39 back in 2011. And then the average is somewhere around 60, 65, 70. So that's a long-term chart of how the ratio is done or how the spread's done. And the next chart shows a little bit of short term. By the way, this is a futures basis. Now, again, we're just trying to get people familiar with both spot terms and futures terms, although you would do this trade in the futures markets, obviously, as you'll see in a second, because of the great margin offsets you get. But since June of 2019, the spread, you see the ratio has gone all the way up to 125 futures basis and has slid all the way down. I mean, gold did okay, but silver did spectacularly. So as a result, the ratio is spread. Silver really was cheaper relative to gold than it was at any other time in history. So it's been an incredible move. And if you were long silver and short gold, it was a very, very good opportunity for you. As a matter of fact, we put this in percentile rankings like we do volatility. The highest that it ever traded was 112.79. It's quarterly data since 1990, spot gold, spot silver too. The 90th percentile was 85.57, 75th percentile was 76.81. The 50th percentile is about 68.55. So we went from, in less than a year, we went from the highest that ever traded to about the 50th percentile. We're just about at the 48th percentile now, so we're a little bit more reasonable. It's had a very, very, very big move. For those that think it's going to continue, get long silver, short gold. For those that think it's going to reverse and gold's going to outperform silver, you would get long gold and short silver. So how do you set up the trade? You can see here's how some of the prices were back last October. And then again, March 15th, which is basically a couple of days ago. You can see this is actually, if you did the trade in October, you made money on both sides of the spread, which is rare. Usually you make more money on one side of the spread than you lose on the other side, and it compensates. The gold-silver ratio has gone from 77 in October to 65.90, or around 66. Silver has gone up from 24.72 to 26.19, but COMEX gold has actually gone from 1900 to 1726 on March 15th. So if you look at the calculations, you're long one silver, you're short one gold if you believe that silver was going to outperform. And then you can see how the margins have changed a little bit. When there's volatility in both markets, as there has been, margins change. In this case, they've actually gone down because margins have gone down a little bit. But the margin offset has gone down too, from 60% haircut to 50%. So it's a little bit different, and as a result, you don't get as much of a discount. The margin discount, margin offset, they're used interchangeably. It used to be in October, it's 11,400, but because now you only get a 50% discount, it's 13,250. So you can do that spread. A lot of opportunities in it. If you believe it's going to continue to move, either way, that's what makes a market. Whether you think silver is going to outperform or gold's going to outperform, there's an opportunity as this spread or this ratio moves. So that's the trade. If you have any questions, feel free to contact us at the CME Group, or go to our website and go to the CME Education, cmegroup.com/education, and you can have all sorts of information on spreading futures in gold and silver. So good trading to everyone, and remember, always do your homework.